You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Jesse Felder, the publisher of the Felder Report. He was formerly a manager and I believe a founder at a multi-billion-dollar hedge fund. So thank you so much for being on the podcast, Jesse. It's awesome to have you here.
Yeah, thanks for the invite.
So Jesse, I first wanted to start off by asking a little bit about your background, your history, and your journey in finance, and how you arrived to where you are today.
Yeah, well, I mean, I was always kind of interested in the markets. I got actually turned on to the markets at a young age. This will date me a little bit, but my dad bought one of the first personal computers that Apple made. I think it was the Apple IIe, something like that, in the early 1980s. And he got me a couple of games to kind of get me interested in learning how to use a computer. And one of those was a game called Millionaire, which was a real kind of super basic stock market simulator. That kind of got me interested in just the whole idea of investing in stocks. And so I started just, believe it or not, I was, in like elementary school, I started reading Barron's on the weekends and just kind of paper trading, just looking up, stock prices on the weekends and Saturday when Barron's would come out. So when I graduated college, I kind of knew that I wanted to go into that field because I kind of had maintained an interest that whole time. And so I went to work for Bear Stearns in their LA office in the mid 90s and was there for a couple of years before I left with my boss, kind of my mentor at Bear, who was essentially running private, separate accounts, within Bear. We left to start a hedge fund firm in LA and did that for a few years before I quit in March of 2000, the same month that the dot-com mania peaked and rolled over. And I moved here to Oregon and have been kind of just writing about the markets and managed my own money since.
Awesome. And so what kind of hedge fund was it? So was it focused mostly on value or was it focused more on, say, macro and trends? What kind of strategy did you use?
Yeah, we had three separate funds. They were all, more just kind of stock picking focused. The primary fund was kind of just a long short equity hedge fund. And so we also had a kind of a more of a dividend approach fund. And we had a short only fund, which you can imagine was a lot of fun trying to manage during that late 1990s blow off in the stock market. But yeah, it was really the long short equity fund. It was supposed to, part of the reason I left was we were supposed to have a value discipline. And my partner and I would frequently get into disagreements as to, what that really meant and what our mandate was. And so, that was pretty much the gist of it.
Got it. And you're sort of more of a contrarian. So for example, recently you did a Macro Voices interview a few months back where you talked about how the stock market was overextended. So what is it like being a contrarian, and how do you go about managing your biases and your emotions while having that kind of approach?
It's difficult. Obviously, the trend, the crowd is right most of the time, right? And so paying attention to trends and momentum is extremely important. And the contrarianism, just for its own sake, doesn't really work in the markets. But I do think that the best opportunities that I've seen in my career are those that were completely out of consensus trades. Recently, gold in late 2015, 2016 got to the point where it was so out of favor that it presented famously. I'm a huge fan of Jason Zweig, but he famously called gold a pet rock in the Wall Street Journal. And, there were just so many signs that the gold price was unduly depressed by extremely bearish sentiment, that kind of all came together and made for a terrific opportunity. I think more recently, last fall specifically, in energy, to the traditional energy sector, there was so much enthusiasm, and there still is, obviously, around kind of green energy and electric vehicles and all these kinds of things, that literally people thought it was the opposite. When the oil price peaked a decade or so ago, that was kind of the narrative, was peak oil, that the oil price is never going back down again because we're going to run out of oil. And I think what was really driving energy last year was this idea of peak demand, that we'd already seen peak demand for fossil fuels, and so that energy prices are never going to go up again. And so you get those types of opportunities where contrarianism can be very, very valuable, because energy stocks are up. Most of the oil and gas producers, exploration and production companies, are up 100% plus over the last 7-8 months, and they're still really cheap. And especially with the macro kind of backdrop, how that's kind of unfolding right now, they still look very attractive. So yeah, I do think you can't be a contrarian for its own sake, but the best opportunities are typically contrarian focused opportunities.
Absolutely. And yeah, how do you make that shift from, running a hedge fund to, managing your own account? What was that shift like, from going from, being an institutional investor to being an individual investor?
Well, it's a real easy shift. To go from all the kinds of constraints that you have. That was part of the reasons why we left Bear Stearns in the first place, was there's so many constraints that, on what we could buy or couldn't buy based on analyst recommendations or what have you. Or, what the investment bank side of things were doing, we would be restricted in certain securities. And so it was like, okay, we need to go out on our own. And then at the hedge fund, there's just, at least the way we did things, they're just restrictions in being able to do what you want to do. I think that, I lean more towards a real focused type of investment process. To me, that makes a lot of sense. I think Warren Buffett's written about, why put money into your 20th favorite idea when you could just put more money into your top 3 favorite ideas. Or like Stan Druckenmiller said, instead, the way he's made money is put all your eggs into one basket and watch that basket very closely. That type of thing appeals to me a great deal, as long as you have, you're disciplined in terms of your risk management. So I think not being constrained in position sizing and all those kinds of things is very freeing.
Definitely. And now I wanted to move, over to talking more about the macro and, sort of your outlook. So, number one, do you think that, we're seeing sort of a secular shift to inflation?
I do. I absolutely do. It's something that I've been writing about for the last 2-3 years, probably, that we're seeing a secular shift, as we're seeing, obviously, the cyclical forces of inflation kind of present themselves, and that would be these base effects and things, and the economy reopening, and just traditional cyclical forces of supply and demand dynamics. They're exacerbated, obviously, by the pandemic, which compresses basically like a recessionary cycle into a tiny window. But I think to me, it's more interesting to look at those secular forces, because things like, you just think, okay, what were the primary forces of disinflation over the last 30-40 years? And globalization, obviously a huge one. Being able to ship production overseas, where there's cheaper costs of labor. It's been a huge disinflationary force. I think we saw, demographically, the baby boomers coming into the workforce and into their peak earning years was a big boost in the supply of labor that kept, wage inflation down. And then, technology too, has obviously been a deflationary force. but I think when you look at going forward, what are going to be the disinflationary forces of the future, and will these trends continue? You could argue that globalization has, to a great degree, already run its course. The ability to further offshore, to further lower your costs. I mean, I think we've probably explored all of the avenues of reducing cost through offshoring, and then some. We've probably taken it too far in a lot of respects, where it's really hurt national security and things. I think that we've seen that with the pandemic and not being able to source PP&E and things like that because of too much outsourcing that's probably happened. So globalization may have at least reached a peak, if not already begun to shift towards back to reshoring of labor, reshoring of production. And so that disinflationary force, I think it's hard to argue, is going to be as powerful going forward as it has been over the past 40 years. And then demographically, I think we're seeing this right now with wage inflation. A lot of it, like I said, is cyclical, but I think some of it is the secular forces of baby boomers retiring and leaving the workforce. And so, I think we saw a big jump in those baby boomers retire, as a result of the pandemic, right? The stock market went way up. And their retirement assets were boosted, by that, and I think a lot of them saw that as an opportunity. Like, heck, why am I taking the health risk of going? Why don't I just call it quits here and retire? And I think we saw, a trend in retirements, get a boost as part of the pandemic. But generally, that huge generation, of labor in the U.S. economy is now retiring. And so there was a great study that I think it was the IMF did. I can't remember. And they showed the relationship between the demographics and inflation. And Japan was really the only country where this trend didn't hold. But in every other country, when you had rising reliance, I guess I'm forgetting the terminology, but a greater percentage of the population is dependency ratio is dependent upon the working population. That's an inflationary dynamic. And so whether that's, a huge burst of babies or, burst in retirees, that rising dependency ratio is inflationary. And you can see, when we spend here in the United States so much on healthcare, how baby boomers aging and leaving the workforce, creating potential, reducing the supply of labor, at the same time putting more strain on the healthcare system. That could be an inflationary force going forward too. So a lot of people say demographics is destiny, and they argue that's a disinflationary, deflationary force. I think it's the exact opposite, is that we're seeing the demographic shift in such a way that's very likely inflationary. So, I mean, there's a lot of moving parts here, but those are kind of the big ones, and how I view that right now.
Got it. And to complement sort of this, shift in demographics, policymakers have also started using excessive amounts of fiscal policy. So, do you think, number one, policymakers have become progressive, and in a sense, do you think that this excessive use of fiscal policy is going to continue, and do you think that dynamic is going to hold over say the next decade or the next 2 decades, or do you think that's going to shift back to normal, and we're going to see fiscal policy go down a bit?
These things also all go through long cycles, and I don't think you see the types of shift, towards the consensus now is that the reason that the economy was so weak coming out of the great financial crisis was we didn't use enough fiscal policy. We didn't do enough. And so I think that economists of all stripes agree, on that issue. I think politicians agree, and I think the Fed, agrees. And so, if anything, what we're going to see going forward today is that them overdoing fiscal rather than underdoing. I think the consensus is that the risk is greater in underdoing the fiscal side rather than overdoing. So yeah, I think that's the bias. And it's a great point too to notice that, because I do think there was a major shift in monetary policy that we saw in the fall of 2019. And I think up until that point, from 2009 to 2019, that 10 years of monetary policy was quantitative easing. I mean, and that was what the Fed told us that it was. We're going to try and use monetary policy to, basically, boost the, risk assets and create a wealth effect in order to try and boost consumption and the economy. And it was, the Fed's version of, trickle down economics. And it obviously didn't work great in terms of boosting the economy, but it worked great in terms of boosting asset prices. But it didn't result in inflation. And so I think what we've seen in 2019, I think when the repo markets went haywire in the fall of 2019, to me, that was a reaction in the markets. This is just my interpretation, that there were, as a result of the Trump tax cuts and the deficit going from 500 billion to $1 trillion during an economic expansion, we've really never seen that type of a massive surge in the deficit during, outside of a recession, except in the late 60s. So, late 2018-19 was kind of the first time we've seen this in a long, long time. And I think the markets just couldn't bear the amount of increased debt issuance that had to be, created in order to fund that deficit. So, Treasury bill issuance went huge, had to accelerate. We saw, I think, the only people really buying a lot of those, bills, or at least able to soak up that excess supply, was hedge funds, putting on the basis trade, and so when the repo markets went haywire, that was to me a sign that there just wasn't the natural demand out there. When the hedge funds couldn't continue to put on this basis trade, there wasn't the demand out there for this stuff. And so, the Fed had to step in at that point and say, okay, we need to start directly monetizing these deficits. This is no longer quantitative easing. This is intervening in the Treasury market to prevent, problems in repo, problems in, with interest rates going up too fast. And really, to me, since the fall of 2019, the Fed has gone from QE. We're no longer in QE world now. We're now into directly monetizing deficits, and that, paired with the deficit going from $1 to $3 trillion in fiscal policy, driving that, you are creating a massive inflationary dynamic that we haven't seen in the 10 years of QE prior to that point.
Got it. And, when you talk about this dynamic of, the Fed intervening in the Treasury market to prevent problems, what are your thoughts on a possible, tapering and a taper tantrum? A lot of people have been talking about tapering coming much sooner than the market expects. So, what are your views on that?
I think they have to start talking about it, right? They're now talking about tapering, and I think they have to, because to me, the number one chart I've been watching since that repo debacle is the dollar, because to me, my friend Bill Fleckenstein has said at some point, the bond market's going to take the printing press away from the Fed, and I think he's since revised that view, to say that, yeah, I mean, because the Fed can implement yield curve control. If the bond market, the bond vigilantes come back in a big way and say, we're not going to, and to me, they have. If you look at foreign ownership of treasuries, it's dropped dramatically in the last year. And that's, basically the bond market vigilantes say, no way, we're not going to continue to buy, 30-year bond at, 100 basis points below CPI. It's nuts, or more. And so, foreign investors have rapidly reduced their treasury ownership. But it hasn't made a difference because the Fed is buying so much. So, the bond market is not necessarily going to be the thing to take the printing press away, but what could is the dollar. And I think that's really the outlet for a lot of this. I think the Fed is talking about tapering to try and protect the currency. If you look at the dollar right now, I mean, it rallied over the last few months. Kind of the end of last year, beginning of this year, it kind of tested those lows that we saw a couple years ago. It's rallied, and now it's coming right back down to those lows. And if it breaks down, I mean, to me, that's a sign that the Fed may be forced to start tapering. because they can't afford for the dollar to really roll over hard. And because if you think about it, we're already seeing CPI, headline CPI over 4%. And that's with the dollar essentially going sideways. If the dollar starts really rolling over hard, I mean, that could exacerbate inflationary, forces where, imports become more expensive and all these things. And really, to me, the main driver of inflation over a longer period of time beyond the cyclical is people's faith in the currency. If people lose faith in the currency, that is a big problem for the Fed. That's losing faith in the central bank, and so that's something they want to raise inflation expectations without people losing faith in the currency, and they're playing with fire. It's a very difficult game, and so that's why, to me, it's watch the dollar index right now.
Do you think that bonds, the bond market as a whole is in a sort of bubble, or seeing some excesses in the bond market? What are your views on that? I believe the legendary investor Jim Rogers is called the bond market the biggest bubble he's seeing at the moment. So just wanted to get your thoughts on it as well.
Yeah, I mean, bond prices are ridiculous, right? I mean, what are we at, like 2.3% on the 30-year, and core inflation is over 3%. And so, the real yield on the 30 years, like, negative 80 basis points or something. It's ridiculous. Nordia's done some good work here too, showing that when CPI is X, the 10-year yield should be Y, and it's nowhere near, where it should be. So, there's a possibility, and I don't even know how you analyze this, that, we're already seeing yield curve control with, the $80 billion of purchases a month, might be enough to kind of just pin the yield curve, without explicitly saying we're engaging in yield curve control. But to me, yeah, bonds are absolutely a bubble. The corporate bond market too. You see junk bonds, sub 5% yields. It's to me, that's problematic when defaults are historically, average 5% a year, depending on where you're on the cycle, of course. But but to me, equities are even a bigger bubble, and people compare. Okay, well, let's look at the yield on treasuries versus the earnings yield on stocks, and I don't think that's really a fair comparison. When you look at things that are really good at forecasting returns in the stock market over a 10-year period, and I'm talking about like the Buffett yardstick, or my friend John Hussman has done probably the best work I've seen here, where he uses things like total market cap to gross value added and things. And they're all kind of different types of price to sales measures. When you look at those things, they all suggest we're going to see negative returns in the stock market on average, including dividends over the next 10 years. And that could be anywhere from like minus 2, 3, 4, 5%, per year on the stock market. So, that is nominal, so then throw inflation on top of that. And you could be, be looking at, real losses from the stock market, in the high single digits, easy. And, that to me makes a 30-year, at 2.3% look pretty good in comparison, actually. So, I mean, you can argue all day until you're blue in the face about which one's the bigger bubble. I think that, assets of all kinds are in bubbles today. We see it in the real estate market. The St. Louis Fed just put out, the price to rent ratio of the U.S. residential real estate market, and it's higher today than it was at the peak of the housing bubble. So almost any market you look at is at, ridiculous valuations today.
Got it. And since you gave your thoughts on the USD, and you think the USD is probably going to head lower, what are your views on sort of the reserve currency status of the USD? I believe, Luke Romans made some comments about, the USD losing its reserve currency status. And, there are some inflationists, as they call themselves, who've said that, the USD is likely to lose its reserve currency, status over, say the next decade or the next 10 decades. So just wanted to get your views on that as well.
Yeah, I mean, I think the writing's on the wall. I don't think you can run, fiscal and monetary policy like you're running today and expect to keep, the global reserve currency status. It's just, it's not my area of expertise. I mean, I would defer to somebody like, Stan Druckenmiller, who famously, with George Soros broke the Bank of England. And he's saying for the first time in his career, he thinks in the next, I think he said 15 years that we'll lose reserve currency status. And so, to me, somebody who's, probably the greatest macro trader of, his generation, if not of all time, when somebody like that says that, you need to pay very close attention. And, but I mean, yeah, just from a fundamental, standpoint, you look at it and you go, yeah, of course you can't run multi-trillion-dollar deficits and be directly monetizing it indefinitely with no plan for, reining in any of it. There's literally no appetite in Washington to deal with deficits. And there's no appetite at the Fed to try and normalize monetary policy. And so, yeah, to me, that to me, the writing is on the wall. The reserve currency status is going to be called into question if it isn't already. I mean, we're seeing already, like I said, foreigners abandon the treasury market. That's a major sign.
Yep. And you also see that central banks around the world are sort of introducing what they call CBDCs, or central bank digital currencies. The digital euro, the digital yuan, and there's also talks of a digital dollar. So what are the implications in your view of these CBDCs?
Well, my number one takeaway from that is, and I've said this, I had Eric Townsend on my podcast a few years ago. He's one of the people I kind of defer to in terms of crypto. I think he's a really brilliant thinker, and he's brought up this risk, and it's another one that's just just common sense. That central banks are not going to give up control of the currency. So to think that something like Bitcoin or any other crypto is going to be allowed to garner the type of adoption to displace, fiat currency, I think is extremely optimistic, for, crypto bulls. But it's also, probably delusional. I mean, there's just no way that central banks are gonna allow that to happen. And so I do think probably, central bank digital currencies are going to be the way that they, make this happen. Is that they say, okay, we're going to create our own version, and it is the only lawful version. If you want to, trade in the digital realm, transfer monies and however you want to do, you got to use the central bank digital currency. And I think the biggest short-term risk, the biggest driver of CBDC, I mean, where they're really, the impetus is getting stronger and stronger, as we're seeing a lot of this, these ransomware attacks and things that are all demand payment in crypto. And so I think that is a major, we saw with the pipeline being shut down, and more lately beef producers being attacked. When you attack kind of the foundations of the economy and the only thing that really makes it possible is cryptocurrency, that to me is a very clear message to the powers that be that they have to step in. They have to prevent these types of things and protect the economy. And that is also a wonderful excuse for protecting their monopoly on printing currency.
Got it. So where do you see opportunity today, especially when you put on, your contrarian or your value investor hat? Well, where do you think, where do you think there's opportunity? Where do you see things that are cheap?
Well, to me, I think over the last few months, I started getting really bullish on precious metals again. They had a huge run, last year, and when all the money printing was announced. But then, from last summer, they rolled over pretty hard, and we saw a lot of money flow out of ETFs. We saw a lot of sentiment turn against the precious metals. And it's interesting to me because the macro backdrop for precious metals is still about as strong as I could imagine. And I think the main driver that I look for the gold price is the real 30-year yield. So I just take 30-year Treasury less core CPI, and that has a really, really high correlation to the year-over-year change in the gold price. So when that 30-year yield goes negative in real terms, it's very bullish for the gold price, and vice versa. So we had negative when yields really plummeted in February, March of last year, is in reaction to the COVID, the pandemic. That was yields going deeply negative in real terms, and that was bullish catalyst for gold prices. But then in the summer we saw yields rise, from really low levels. Nominal yields start rising again. And then we saw inflation start reflecting, the pandemic and inflation coming down. And so real yields backed up. And so that was, to me, the number one catalyst for the correction in the gold price. That correlation has still stayed very, very strong. And it kind of told you it's time to, be wary with real rates rising. It's time to be more cautious towards gold. But starting in about March or April, we saw yields top out. And we knew inflation was going to start picking up again. And so real yields were going to come back. And actually in April, when the May number came out, they went more deeper negative than I thought they were going to go. And to me, that was a very, very bullish catalyst for the gold price. Typically, when you see negative real yields on the kind of where they are right now, we see the gold price up 20% year over year. And we're still close to flat or something on the gold price year over year. So if CPI continues to come in hot and yields don't go up, like we've been seeing, gold could easily break out to new highs. So I think, to me, that's one of the things from a contrarian standpoint, I loved seeing this fundamental setup and for precious metals really develop bullishly over the last few months. At the same time, we saw outflows out of precious metals ETFs, like gold ETFs. Sentiment really turned negative. And to me, that was a terrific setup and still is for the gold price going forward.
Got it. And would you rather, own gold as bullion, or would you rather own the miners?
Probably a little bit of both. I mean, I do have, I have a core position that I'm going to have on, in this type of environment, no matter what. But I also am trading it opportunistically. Trading side of it, it's really, I use for a lot of that trading position, the Sprott Physical Gold and Silver Trust. It's a closed-end fund that trades, regularly trades at 5-6% discount to its net asset value. And I don't know anywhere else in the world I can go buy gold and silver for 5% less than market price. What I also like about those is that it's, it's now backed by Sprott. And if you, own, I don't know how many shares it is, but if you own, minimum number of shares, you can convert those shares into bullion. So that's, and there's even, I think, I don't know if you follow Doomberg on Twitter. It's kind of a new blog that Grant Williams introduced me to. He's been writing about how, I think on Reddit, there's a forum where a lot of, they've been trying to figure out a way to buy up the physical silver fund through Sprott. Because it can be converted to bullion, you can kind of, the theory is, buy up a bunch of shares, and because you can physically convert it to bullion, you can potentially kind of create the type of squeeze that we're seeing in a lot of the, names like, GameStop and more lately AMC, even though I don't think AMC is a short squeeze this time. It's probably more of a gamma squeeze, but yeah, I think we may see something like that in the precious metals.
And earlier in the interview, you talked about energy as well. So do you continue to see energy cheap? And if so, what specific sectors of the or what specific industries in the energy sector do you see?
Well, I think one of the things that made me so excited about energy, I mean, when I look back at last fall, obviously energy became extremely out of favor. We had a lot of, like I said, those peak demand articles, and everybody believed fossil fuels are over. right? Like it was almost like we're never going to burn another fossil fuel going forward. And I mean, you can look at any of the studies, and even if 50% of auto sales 10 years from now are all electric vehicles, still the vast majority of cars on the road are going to be all combustion engine vehicles. So we're going to be burning fossil fuels for a long, long time, no matter what we do. So the peak demand case, that obviously we're going to get to peak demand at some point, but we're not there yet. What's most interesting to me, I think, about energy right now is if you do believe, I believe in the inflation. I believe inflation is not just here on a cyclical basis, but it's a new secular trend, that disinflationary forces have bottomed, and we're going to see an uptrend going forward. That doesn't mean it's a straight line and we're going to go see 4, 5, 6, 7, 8% CPI, but I do think we're not going to see a downtrend anymore. If the markets believed that, if inflation was priced in, interest rates wouldn't be where they are. CPI, the futures markets and things in CPI wouldn't be where they are. We wouldn't see also stock prices, where they are. The segment of the stock market that is most highly correlated with interest rates, essentially the longest duration segment of the stock market, is the most overvalued relative to the rest of the market that it's ever been. So at the same time, the segments in the stock market, which probably energy and mining, that are best performers during an inflationary episode, are the cheapest they've ever been relative to the rest of the stock market. So the stock market is pricing in disinflation as far as the eye can see, and to the greatest degree that it has ever done in history. So to me, that says there's an incredible, that in assets, stocks and segments in the stock market that benefit from inflation have never been cheaper. And it's incredibly ironic to me that that's happening at the same time when inflationary forces are probably the greatest they've been in 40 years. And so energy is one of those, is part of that from a macro, standpoint, but also, from just more of a micro, bottom up standpoint. Fundamentally, I want to find things that are not just cheap relative to the rest of the market, but cheap relative to their own history. A lot of these stocks are still very cheap. And it's really one of the only areas in the last year where I've seen massive insider buying. And that's one of the things that I've tracked, since my hedge fund days, 20 plus years ago, is, we saw Harold Hamm, buying massive amounts of Continental Resources last fall. And we still see, insider buying. I'm amazed a lot of the energy stocks that I was buying last fall and still own today are the infrastructure stocks, pipeline companies, and these types of things. And not just the MLPs, but a lot of them have converted to C Corps, like, Kinder Morgan. And when you look at them as a group, they've typically, throughout their history, they've traded a yield that is more kind of like a junk bond yield, if you had the kind of a junk bond spread over treasuries. Today, the spread on a lot of these companies, is still like 8 to 10%, right? I mean, you're getting an 8-9% yield, on top of what you would get, on top of treasury yields. To me, that spread is still far, far too wide. And when people realize that, okay, we're going to be using fossil fuels for a long time, these pipelines are going to be used for a long time, this is all still very valuable stuff, and it's generating cash flow. Massive, cash on cash returns for investors who are, willing to go into the space. I haven't even mentioned ESG, but the popularity of ESG is really what's driving the cheapness of a lot of these things. Is, I think there's a lot of different ways to interpret ESG. The one, constant is no energy. So all of them say we don't want to own oil and gas producers. We don't want infrastructure. And so ESG assets have just screamed higher. And that, the fact that they all, exclude these assets means that there just hasn't been any buyers for them. And if you want to be ESG compliant, if you're a mutual fund manager, you're active, whatever, and you want to be ESG compliant, you gotta dump these things. And so I think that's why they got so cheap. It's also why they, have created such a terrific opportunity, even in the midst of all these inflationary pressures that we're talking about.
Yep, absolutely. And So, when you talk about, you sort of your value framework for actually analyzing stocks bottom up. So one of the factors you mentioned was, insider buying. So what else do you consider when you make a decision to purchase a stock?
Yeah, so a good friend of mine, Todd Harrison, he started a company called Minionville back in the early 2000s, I think, and used to do a ton of great writing about the markets. If you're interested in cannabis stocks, you got to follow Todd. His whole new thing is cannabis wellness. He's brilliant. But Todd's framework, I think he explains it really well. There's four legs to the trading stool. There's fundamentals, sentiment, technicals, and macro. And when all those things work together, you really can enhance your probability of a winning trade. So fundamentals, to me, I want to find something that's cheap. Sentiment, usually cheap because it's out of favor. Technicals are, the way I use technicals is I pay attention to momentum. I want to find, so if a lot of times when you find something that's cheap and out of favor, it's in a downtrend. If it has strong momentum to the downside, I don't have any interest in trying to step in front of that falling knife. I'm not trying to, to do that. To me, momentum is a wonderful indicator in the markets of, future short-term price direction. And so I want to find something that's cheap, that's out of favor. It's been in a downtrend, but momentum is waning. So it's potentially showing signs of a change in trend. I use a variety of different, you can use RSI, but you can also use just pure momentum too, like somebody like Michael Oliver does. I also use DeMark indicators to look for exhaustion signals on multiple time frames. So when I can find those three things, and then obviously, like I said, have a macro framework behind that too, to me, when you put them all together, it can be very, very powerful. And those types of opportunities don't come around very often, but when they do, they're the best I've found.
Got it. Got it. I also wanted to ask you, so we sort of have this backdrop now that we're going to see a higher inflation, and you also mentioned a couple of commodities. So we talked about energy and we talked about precious metals. So do you have any thoughts about, say, real estate, and more specifically residential real estate, and how you view that relative to these commodities and equities as a whole?
Yeah, residentials is interesting. It's it definitely feels different this time, which is dangerous to say that, obviously, right? The four most dangerous words in investing. But I distinctly remember the housing bubble. And really what burst the housing bubble was the supply coming on. Obviously, there were bad loans and all those kinds of things that, were the catalyst for the financial crisis. But ultimately, it was supply and demand. We had massive demand for houses. And in 2005, I was living in Bend, Oregon at the time, and you couldn't go to, Bend was the number one or two most overvalued real estate market in the country. Small little town, 50, 60, 70,000 people at the time, probably. But you couldn't go to anybody's, backyard barbecue without talking to anybody who was bragging about pulling out their home equity, leveraging it into 3 or 4 or 5 or 6 spec homes. I literally knew one guy who was, successful software guy and leveraged home equity in one house into 15 spec homes in 2005. And it was absolutely, insane. And so there was an incredible surge in demand, on the part of speculators. And at the same time, home builders responded to that demand in spades. They said, we're going to just produce a bunch of new homes. And then a lot of people were inspired to just sell their primary residence and, downsize or what have you. And so you had a supply and demand dynamic that created a major bust. When that demand went away from speculators and the supply came on, it was 2011, 12 was a wonderful time to be a buyer in the residential real estate market. People at the time were saying, I'll never own a home again as long as I live. It's hard to remember these things, these sentiment things, you get so dramatic, but literally people, went from 2005, 6, 7, residential real estate is the best investment in the history of the world, to 2011, 12, I'll never own a home. I'm going to rent for the rest of my life. And those are really good kind of signals, that, you're near an extreme. I think what's different today is, part of this boom is driven by demographics. We're seeing, millennials, reach an age at which they want to buy a home and start a family. And, millennials, the biggest generation in US history. So there's a lot of, buying demand there that is just, demographically driven. It's not cyclically driven. And then supply is constrained. You see a lot of builders today, instead of meeting all this demand with a big surge in supply, they're saying we can't produce the homes because we don't have the labor, and lumber costs are too high, and copper price, and all these things. And so they're literally stopping production. So I think, we're not going to see, literally prices, here in Bend are up 50% year over year. It's ridiculous, and it's totally unsustainable. But I don't necessarily see a bust, like we saw. I can't imagine prices going down 50% very easily, especially outside of recession, and especially without interest rates going up. I don't think the Fed can allow interest rates to go up, so I think rates are going to stay low. That will probably be supportive. The demographics, like I mentioned, will probably be supportive of residential for a long time. I'm not bullish, obviously, on residential over, from current prices, but I'm also not too bearish.
Awesome. Thank you. Anything else that you wanted to cover that we haven't covered already?
No, I think we kind of ran the gamut. That was pretty good.
Awesome. Well, to wrap it up, any closing thoughts? Nothing?
We didn't really talk too much about the broad stock market. I do think it's pretty clear to me that that valuations are higher than they've ever been before in history. That's not a timing signal, but to me, what is typically a pretty good timing signal for the stock market is just risk appetites. And I think we've seen, obviously AMC is, doing its thing lately, but I think we've seen risk appetites. There's signs of risk appetites kind of rolling over in the markets. We've seen a lot of the ARK stocks, the Cathie Wood stocks, start to struggle. Tesla start to struggle.
Yep.
A lot of the big, tech stocks. A lot of these things are down 50% off their peak. Zoom and Peloton, and to me, that is a warning sign. It really does remind me of 20 years ago, the peak of the dot-com mania. We saw the NASDAQ peak in March of 2000. The New York Stock Exchange went on to make a new high kind of in September of 2000, but there was a big divergence where a lot of those momentum and tech favorites weren't able to even come close to a new high, already starting to roll over. And so that divergence and that breadth disparity was a clear sign that something was changing. And I think there's a possibility we're seeing something similar in the stock market today, where the uniformity is just not there, and that's something to be concerned with.
Got it. Well, thank you so much for being on the podcast, Jesse. It was awesome having you.
That was a great chat. Thanks for having me on.